And here's Bitcoin to gold. You can see that Bitcoin to gold is maintaining its uptrend. We'll see if it breaks out. I think the risk-on trade has helped it recently, and we think that will be the case. When that case will continue when it is clear that we're not going into a long-term recession, that the Fed is going to ease, and that a strong productivity-driven boom, I would say, in economic growth is underway, paving the way for midterm elections that should favor the majority now. So with that, I know a lot of puts and takes, a lot of charts, but it was a busy day for sure in the markets, a lot of fear surfacing once again.
Cathie Wood starts her research by focusing on global liquidity, one of the most important elements influencing markets today. She highlights how changes in monetary policy and the speed at which technology is developing are having an impact on capital flows and asset values generally. She discusses how these factors may pave the way for big opportunities in the future, ranging from high-growth tech equities to Bitcoin and other digital assets. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
A lot of those are clearing up right now, and one of the big variables that many people are wondering about now is interest rates. This week, Chairman Powell sounded very hawkish. I think he didn't appreciate being featured along with President Trump at a construction site. So there may have been something else going on there, because the data as it is evolving here is certainly moving in a direction that would lead the Fed to ease. And of course, for the first time since 1993, there were two dissents on the Fed board this time around. And that suggests that we probably are going to see interest rate cuts in the future. I think the odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. So we think that will resolve positively as well. That's the one uncertainty. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up, with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. And then to address the dollar, I know that the headlines were blaring, worst dollar start to the year, our worst first half since, I think, 1993, if I'm not mistaken, which, by the way, was the last time two Fed directors had dissented from the policy being made. So you can see that all of that drama put in context was a little exaggerated, shall we say. And if you look at the next chart, I did present it for the first time last month, you can see here that the uptrend has not been broken. And if we're right on return on invested capital, it will resume its increase relative to the 26 countries in this index. Inflation, as measured by commodities, it is kind of shocking still that tariffs notwithstanding, it's today where it was in the early 90s and in the early 80s. Here's The S&P price to gold, this we're paying a lot of attention to because some of the best strategists out there, our friends at GovCal, have been suggesting that we were going to spiral down into a 70s environment with tariffs causing inflation and so forth. The market's been weighing that risk, as you can see here. The most recent move, however, in this index has been up, and we think it will resume as we get through this uncertainty, especially the uncertainty around recession and the Fed. Here, relative to oil, we think this is a leading indicator of what will happen, and it looks nothing like it did in the 70s. Here, I always like to keep this chart in mind. I started my career really near the peak of interest rates, and have been riding down the curve throughout my career, which was delightful. But you can see there's a downtrend, which is good up to a point. What did near 0% Treasury yields mean? It meant, in the case of COVID, are we going into a deflationary bust? And we got out of that. And maybe we have just bounced back to something more normal now that the Fed is letting markets work. We do think that the Fed is actually erring a bit in the other direction, as I mentioned before, and that will change. And with it, we do think interest rates along the entire yield curve will come down.
According to Cathie Wood, capital investment and housing will be the two main areas driving the next economic rebound. High mortgage rates have kept the housing market in a deep freeze, but she thinks things are starting to change as prices begin to drop and affordability gradually improves. Cathie anticipates that the housing market may accelerate in as little as 6 months if the Federal Reserve lowers interest rates this fall. She also cites capital expenditures as a significant motivator. Businesses might be more inclined to fund high-impact projects that not only directly create jobs, but also encourage more spending across the economy if taxes are clarified and financing costs are reduced. She believed that the combination of these two factors could pave the way for a robust recovery. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
And here's Bitcoin to gold. You can see that Bitcoin to gold is maintaining its uptrend. We'll see if it breaks out. I think the risk-on trade has helped it recently, and we think that will be the case. When that case will continue when it is clear that we're not going into a long-term recession, that the Fed is going to ease, and that a strong productivity-driven boom, I would say, in economic growth is underway, paving the way for midterm elections that should favor the majority now. So with that, I know a lot of puts and takes, a lot of charts, but it was a busy day for sure in the markets, a lot of fear surfacing once again, and yet the way we're interpreting this is another indication that the market is climbing a wall of worry. And we need these shudders every once in a while to keep speculation in check. And we think that's just another one of those checks. As I mentioned, Chairman Powell sounded quite hawkish, even though reporters were saying, well, wait a minute, housing seems to be relapsing. And he deflected that. And, well, wait a minute, the metrics you look at in terms of core growth and core inflation, they're all moving in the right direction when it comes to inflation, and actually in the wrong direction when it comes to GDP growth. I think I'm not going to get the metric exactly right, but what Chairman Powell focuses on is real private domestic final sales, and that is running in the 1% range. And we saw that with the consumption figures, very slow. The consumer is becoming quite cautious, and beginning to lift the savings rate. We think that could cross 5% this year. But you see, money growth did start turning around. It was negative for quite a while. We're now up to roughly 5%. But when you get cautious consumers, that means the velocity of money, the rate at which it turns over, slows down. So the stimulative effect just isn't going to be there the way that this chart might suggest. We also know that the CPI, which is depicted in the green here, faces some tough comparisons. So I think we have two more tough comparisons at the 0 and 0.1% rate for the next couple of months. So the inflation rate could stabilize here, and maybe that's what Powell was responding to, just knowing that the optics aren't going to look great on inflation, meaning continued progress. But if we're right, that will be it. Then we're off to another leg down in inflation towards the 2% and actually below the 2% range if we are right.
Even if housing is exhibiting symptoms of a relapse and key inflation indices are going in the right way, Cathie Wood pointed out that Jerome Powell's recent tone was unusually aggressive. Powell concentrates on real private domestic final sales, a particular economic indicator that is expanding at a rate of just 1%, suggesting that the underlying economic momentum is weak. Customers are being more frugal and conserving more money, which may surpass 5% this year. Even though the money supply has increased by around 5%, cautious consumers ensure that money velocity, the pace at which money moves, remains modest, which lessens its economic impact. She said that inflation will probably have to contend with difficult year-over-year comparisons for 2 more months before declining once more and possibly falling below the Fed's 2% objective. Although tariffs might make this more difficult, overall patterns still suggest that inflation is declining. Cathie further pointed out that the yield curve is still significantly inverted, which is a clear indication of tight monetary policy. Recessions have usually resulted from such circumstances in the past, and she thinks the current rolling slowdown may develop into something more serious. The two industries she believes have the most potential to spur a recovery and are most susceptible to interest rate changes are housing and capital expenditures. While affordability is gradually increasing due to lower mortgage rates and declining housing prices, capital expenditures may increase now that tax laws are more clear. She claims that both industries have high multiplier effects, meaning that investing in these sectors leads to more expenditure across the economy. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content. And as always, happy investing.